What if I told you that I know a secret to become a successful billionaire by just knowing some basic rules or strategies? Well, as we all know, Warren Buffett, who is known as the Oracle of Omaha, is one of the most successful investors of all time. He has built a fortune worth over $109.7 billion through his company Berkshire Hathaway, and is widely respected for his investment prowess and long-term approach to investing. Over the course of his career, Buffett has shared his wisdom and insights on investing with others, including his 6 rules of investment strategy. Warren Buffett's investment success is unparalleled, and his methods and philosophy have been studied and emulated by investors around the world. Despite his immense wealth and status, he is known for his down-to-earth and practical approach to investing, which emphasizes the importance of patience, discipline, and a long-term perspective. His 6 rules of investment strategy provide a framework for investors to follow and offer valuable insights into how Buffett has been able to achieve such remarkable success. Whether you are a seasoned investor looking to refine your strategy or a beginner seeking to learn the basics, understanding Buffett's investment philosophy and principles can be a powerful tool in achieving your financial goals. In today's video, we'll explore business tycoon Warren Buffett's 6 rules in investment strategy. Number 1. Cash is never a good investment. Warren Buffett has often expressed his opinion that holding on to large amounts of cash is not a good long-term investment strategy. He believes that cash is a poor asset to hold for an extended period of time because it generates very little return, especially when compared to other asset classes like stocks or bonds. He has often emphasized the importance of investing in productive assets that generate cash flow and create value over time. He believes that businesses that are able to generate high returns on invested capital are the best long-term investments. While Buffett acknowledges the importance of having some cash on hand for emergencies or for taking advantage of investment opportunities that arise, he generally advises against holding on to too much cash for too long. He famously once said, "Cash combined with courage in a time of crisis is priceless," but also warned that cash will become worth less over time due to inflation. Number 2. Invest in productive assets. Buffett is a firm believer in investing in productive assets, which are assets that generate income or cash flow over time. He has often spotlighted on the importance of investing in businesses that are able to generate high returns on invested capital, and has famously said that he likes to invest in companies that have a moat around their business, which means that they have a sustainable competitive advantage that protects their profits and market share. Buffett's investment philosophy is focused on identifying high-quality businesses with strong fundamentals and a sustainable competitive advantage, buying them at a fair price and holding them for the long term. He believes that by investing in productive assets, investors can generate higher returns over time than they would by holding onto cash or investing in speculative assets. In addition to investing in productive assets, Buffett has also emphasized the importance of diversification and avoiding excessive risk. He advises investors to focus on their circle of competence and to only invest in businesses and industries that they understand well. Overall, his opinion on investing in productive assets is based on his belief that investing in high-quality businesses with strong fundamentals and a sustainable competitive advantage is the best way to generate long-term wealth in the stock market. Number 3. Stay in your circle of competence. Warren Buffett is a strong advocate of staying within one's circle of competence when it comes to investing. He has often emphasized the importance of investing in businesses and industries that one understands well and has a deep knowledge of. He believes that by staying within one's circle of competence, investors can minimize their risks and increase their chances of making wise investment decisions. He advises investors to focus on investing in businesses that they know well, and to avoid investing in businesses or industries that they don't understand. Buffett has famously said risk comes from not knowing what you're doing. He believes that investors should only invest in businesses and industries that they have thoroughly researched and understand, and should avoid investing in speculative or trendy stocks that they don't have a deep understanding of. Number 4. Evaluate companies first. Warren Buffett supports the idea of evaluating companies first before investing in their stocks. He thinks that in order to make wise investment decisions, investors must thoroughly research and analyze the underlying businesses they are investing in. Buffett has often focused on the importance of evaluating a company's financial statements, management team, competitive advantages, and growth prospects before investing in its stock. He advises investors to focus on businesses that have a strong track record of profitability, a competitive advantage that can be sustained over time, and a management team that is aligned with shareholder interests. Buffett believes that by evaluating companies first, investors can identify high-quality businesses that are likely to generate strong returns over the long term. He advises investors to avoid investing in companies that they don't understand or that have poor fundamentals, and to focus on investing in businesses that have a clear competitive advantage and a strong management team. Number 5. Play big and don't waste opportunities. Warren Buffett has often highlighted the importance of taking calculated risks and seizing opportunities when they present themselves. He accepts the fact that in order to generate strong returns over the long term, investors must be willing to take bold actions and make big bets on high-quality businesses that have a sustainable competitive advantage. He advises investors to be patient and disciplined, but also to be opportunistic and to act decisively when good investment opportunities arise. Buffett has famously said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." He believes that successful investors must be willing to take bold actions and make big investments when the time is right, and that they must also be willing to wait patiently for those investments to pay off over the long term. And finally, number 6, invest in yourself. Warren Buffett has a staunch belief of investing in oneself, both in terms of personal growth and education. He thinks that in order to achieve success in life and in business, individuals must continually seek to improve themselves and their skills. Buffett has given importance to reading and learning as a way to improve oneself and make better investment decisions. He has famously said, "The more you learn, the more you earn," and has encouraged others to take the time to invest in their own education and personal development. He has also spoken about the importance of developing good habits and a strong work ethic, and of taking care of one's physical and mental health. He believes that individuals who take care of themselves and their well-being are better able to make wise decisions and achieve success in all areas of life. So why is it important for us to use these strategies? These Warren Buffett investment strategies have been closely followed by many aspiring investors. The importance of Buffett's 6 rules in investment strategy lies in their potential to help investors achieve success in the stock market. These rules are based on Buffett's own experience and approach to investing, which has been refined over decades of practice and analysis. By following Buffett's rules, investors can learn to make more informed investment decisions, avoid common mistakes, and achieve greater long-term returns. Specifically, Buffett's rules emphasize the importance of value investing, maintaining a long-term focus, focusing on quality companies, being patient, and avoiding unnecessary risks. These principles can help investors identify undervalued stocks, build a diversified portfolio, and avoid market volatility. Overall, the importance of Buffett's investment strategy lies in its ability to provide a practical, time-tested approach to investing that has proven successful for one of the most renowned investors in history. By following these rules, investors can increase their chances of success in the stock market and achieve their long-term financial goals. In conclusion, Warren Buffett's investment philosophy is grounded in a long-term approach, a focus on productive assets, and a commitment to investing in oneself. He emphasizes the importance of staying within one's circle of competence, evaluating companies thoroughly before investing, and avoiding the temptation to speculate or make impulsive decisions. Buffett's 6 rules of investment strategy provide a framework for investors to follow and offer valuable insights into how to achieve long-term success in the stock market. His success and reputation as one of the most successful investors of all time have made him a role model for many, and his investment principles continue to inspire and guide investors around the world. Whether you are just starting out or have years of experience, Buffett's approach to investing can provide valuable lessons and insights that can help you build wealth and achieve financial security over the long term. Thank you for watching this video on the story of business tycoon Warren Buffett revealing his 6 rules in investment strategy. We hope you found it informative and engaging. If you did, then please like and subscribe to us here at Crown Luxury for more videos like this. Until then, we'll see you in the next video.